Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Alcana, along with Dennis Dick, and we have Paul LaMonica on the line. He is a digital correspondent at CNNMoney. Paul, how you doing this morning?
I'm good, thanks. How are you?
We're doing good. We're fired up here on this Friday. We got a big Engage investment conference going on at Wayne State, so we have a bunch of young investors in talking about the market. So, what would you tell them about the broad market now? If you had, the sell-off this week, we had the triple witch just kind of hanging out. Do you got any just general thoughts on the broad market?
Yeah, I think right now the big concern, I think, and I wrote about it yesterday, has to be the earnings picture for the first quarter. The profits are likely for the S&P 500 companies to be down. The current estimates are down about 5%. Revenue is expected to slip as well. And I think that should give investors some reason to pause a little bit. And I know this is unpopular in some respects because everyone wants the market to go higher unless you're short, of course. But we have been waiting for a correction for so many years now, and we have not gotten one. Every time it seems like we get to a 5 or 6% pullback, people treat that as if it were the 10% pullback that you would get in a typical correction. We might need that typical 10% pullback to just get some of the froth out of the market, particularly in tech and biotech, and then maybe we return to some more normal levels of market growth. I mean, I think you have to be concerned that profits are not great right now. This doesn't mean that they're going to be terrible all year, but I think caution is probably better right now, at least in the short term. I mean, long term, you ride all this out. You don't worry about the strong dollar for a 3-month period for your long-term financial planning, of course.
Paul, what makes you think that this time is different? Because, like you said, we've been playing, and had a lot of concerns here over the last 5 years, and it seems like
Mm-hmm.
you said, every time we pull back 2, 3, 4%, even sometimes 1 or 2%, the
Mm-hmm.
buy the dippers come in and say, "I've got to come in, I got to buy this market." I've been calling it learned behavior. Anybody investor that's
Right.
came into this market in the last 5 years has learned that if I buy a 4 or 5% pullback, I'm always rewarded. And one of these times it is going to be different. I just wonder why
Mm-hmm.
you think maybe this is the time.
Well, I want to hesitate. I think it's different in the sense that we just need a 10% pullback because look at just this bull market. We have had several 10% pullbacks within the 6-year bull market. We just
Yeah.
haven't had one in several years. So I'm not by any stretch thinking that we're heading into a bear market. I mean, I think that the one thing that is encouraging is that in terms of a financial crisis, hopefully, if the numbers that we see and that the Fed sees in all of the stress tests are, legitimately to be believed, we are not heading, or we should not be in a position where big banks get burned the way they did in 2007 and 2008. There shouldn't be another credit crisis. There shouldn't be any ripple effects with counterparty risk and derivatives really taking everything down. So if that is the case, the only other concern from a market perspective is probably, earnings in the economy. And if the economy pulls back or slows down, that's not a surprise, at least based on the data we're seeing for the first quarter. And then earnings, that's really what drives things. I think people are maybe paying a little bit too much attention to the Fed and central banks and what's going on globally there, and not enough to corporate profits, because that, at the end of the day, is really what is going to dictate long-term accumulation of wealth. I mean, be it just investing something simple like the SPY, because you hope that corporate America broadly will continue to grow over the next few years, or trying to actually be an active stock picker and look for companies that have good valuations and nice growth. So I think that's really the big message I'd have right now, that people shouldn't just give up on this notion that earnings don't matter and that it's all about the Fed and economic data.
I think it's a great point, and I think that Paul, I think you answered that question twice with the exact same answer, and maybe Brent can concur on this. A lot of companies guided lower for next quarter. I mean, there's no doubt about that. We had a pretty good earnings season, but there was a lot of lowered guidance, and that just goes to the fundamentals of the market. They're guiding lower. That's what the market should expect. So it's just a question of whether or not those expectations are met or not. But it's earnings, and that's what you're talking about. Speaking of earnings here, everyone's favorite stock to trade, BlackBerry here, beats the number. Lower revenues. It's been all over the range, all over the map here, under 9, knocking on the door at 10. Could you please give us your take on BlackBerry earnings?
Yeah, I think that the good news has to be, of course, that they are earnings. Sometimes it's a misnomer. I love when people talk about a company about to report earnings and then they report a loss, because that's not earnings. But in the case of BlackBerry, they did report a profit, a legitimate GAAP profit. The sales were much worse than expected, and their lowest level in almost 9 years, and that's not a good sign. But I think that was to be expected. We know that John Chen is trying to push that company away from hardware and more into software and services. So some of the sales decline, I think, is intended, not just the forces of the market being against them, in that everyone is buying iPhones or Android devices and not BlackBerry phones. The big issue is going to remain. It's just, can Chen really pull this off? Trying to move into software in a more agnostic approach where they can have services that support iOS and Android and even Windows Phone. I think that's admirable. Is it too little, too late? And even though he has denied that the company's in play, despite some of the rumors earlier this year about Samsung, you can't help but look back at his prior history. He took over Sybase and did a pretty decent job of turning it around, and eventually sold it to SAP for a nice sum. So I think investors are never going to forget that, and that's always in the back of their mind, that BlackBerry's not going to be a standalone company forever, that Chen just needs to clean it up so that he can sell it. Maybe this time is going to be different. He wants to be there for the long haul, but I think people are going to always question whether or not he wants BlackBerry to be independent, or if he's just prettying it up for Samsung or Lenovo or a variety of other companies that might want to play.
And that's the wild card here, Paul, is that, if you're coming in here and you're not liking the fundamentals of this company, that's the wild card. This thing can get taken over. You saw the action back when just Samsung was rumored, like you mentioned, back on January 14th, the stock spiked 30% in a matter of about 30 seconds. So that's a scary thing. If you're playing this from a short side, even if you don't like the way the company is going, that is a wild card, and they could get taken over.
Yeah, I think definitely that is something that, any investor that has been betting against BlackBerry has to be very careful, because the one thing that has definitely changed since John Chen took over, and I don't want to be too harsh in my indictment of prior management, but I'm going to going to be blunt. Chen actually seems like he knows what he's doing, and I think it is admirable that BlackBerry finally decided to bring in an outsider that is not so wedded to the legacy of BlackBerry, and he's willing to do things that former longtime BlackBerry insiders wouldn't have done, because he's not running the company from the vantage point of, well, we've been doing this for years, and this is the way we have to do it, and obviously people loved our phones, so why not try and make them love us again? I think he realizes that things have changed, the tide has shifted, and the better way to try and capitalize on what's going on in mobile is through software and services and not just hardware.
Speaking of deals, what do you think of this Kraft deal, bringing Heinz back to a public company, merging it with Kraft? Obviously, 3G and Buffett involved here. We really saw a lot of premium jump into Kraft here. Just an incredible move up for usually a lower beta stock. When it moves up from $62, actually got up on the day of the merger up to 87. It's cooled off a little bit since the first day there of trading. But what are your thoughts here on this overall deal for Buffett and for Kraft?
Yeah, with regards to the big jump that you saw with Kraft, I think the one thing that definitely we should point out and remember is that the big pop that it got, I think you need to automatically just subtract the $16.50 in special dividend, because that's one reason why the stock went up as much as it did, because everyone's eager to get that special dividend payout that Berkshire and 3G are financing. But the deal for Kraft just continues to show in my mind that Buffett likes this business, and he's got an ally in 3G that is invested in Burger King and then Tim Hortons, Anheuser-Busch. They seem to both like this slower growth, stodgy, but maybe safe part of the market, and whether or not the new combined company can become an even bigger global player in the food business remains to be seen. But I think most people so far have been pretty positive on what's going on at Heinz, and Kraft is definitely a company that needs a little bit of a kick because their sales growth and earnings growth is not that fantastic. But I don't think Buffett cares about all that in the short term, because he really seems to be just fascinated with the food business. If he was worried about long-term growth that much, he wouldn't have done the deal. He wouldn't be involved in things like Coca-Cola as much as he is, because clearly that's not a sexy growth story.
Just moving on here, we got a few minutes left here with Paul LaMonica. He is a digital correspondent at CNN Money. We talk about bubbles and everything and different aspects of the market. I mean, what's your take on this biotech market? You look at, we can look at the IBB or Biogen. Huge moves here. I mean, you've been around in the markets for a while. Are we looking bubblicious here in this sector, or is it just a little pullback off highs?
It's tough. I think broadly with biotech, there are many stocks that have valuations that don't seem to really be in line with reality, and then you throw in the fact that so many of these companies, particularly the smaller ones, are really trading on hope and hype, and they're very volatile. They can move extremely dramatically based on what's happening with clinical trial results. I think that there's a little bit more rational behavior going on with some of the biotech giants, and I think maybe the pullback you're seeing with a company like Amgen and a company like Gilead, where their valuations aren't insane, though that those might be companies that look a little safer, because they're really more like big pharma these days. They just have higher growth levels than big pharma, so it's kind of like the best of both worlds. You've got a little bit of safety, but some growth as well. So I think broadly, I'd be scared of like the IBB ETF, just because there are so many smaller companies in it that do have high valuations. But I think that there are some individual companies that probably still look pretty promising and maybe have been oversold.
And just a comment on that, at the Engage conference yesterday, I heard Tim Seymour, speaking about it, and he said, a lot of these companies, if the drugs in the pipelines, if they meet their endpoints, if they, get by the FDA, then they're undervalued, right? If they, all these products, but if they don't, and all these products don't come out, then they're way overvalued. So it really,
Right.
That's something you just have to follow.
It's extremely risky, and I think that an investor that is maybe well versed in financial knowledge, but not biology, chemistry, having medical knowledge, that is the big challenge. That you may have a company that on paper looks great, but unless you're really willing to dive into what their individual drugs look like on a scientific basis, that's where you can get caught in the trap. But you're right. I mean, there are many companies that have been reporting losses that I would say you should stay away from them. But they have one drug that does well, and then not only do they maybe look undervalued, they get the attention of the Mercks, the Pfizers, the Glaxos of the world, all the big pharma companies that we know about their problems with their pipelines, and they're happy to pay a big premium for a smaller biotech that may be even losing money, because it could just mean another blockbuster drug that they don't already have. But that's one thing if you're Pfizer to make a big bet on a biotech. It's different between that and, say, you as an individual investor.
That's some great investing advice, Paul, and we really appreciate it for people that are looking at that sector. Paul LaMonica, digital correspondent at CNN Money. Thanks a lot, Paul. Great input. We hope to have you back on again soon.
Thank you. I appreciate it. Have a great weekend.
Thanks, Paul.